Welcome to the Teaching You to Fish podcast, financial literacy for the rest of us. My name is Carl Fish, and I'm the host of this podcast. This is episode 17, Leaving and Receiving a Legacy. A topic that many people don't like to think about is estate planning. Estate planning is the general term given for preparing documents that handle both your financial and physical situation in the event of your incapacitation or death. This is not a comfortable topic for many folks, but what they need to realize is that estate planning is about life, not about death. It isn't really about you. You are going to be incapacitated or dead. It's about the loved ones in your life. It's about making sure not only that they receive any assets you want them to receive, but that you make this incredibly difficult time for them easier. I've known several people who have had people close to them die who didn't have estate planning documents, and it was a tremendous burden on them, as well as sometimes a financial strain. Imagine someone being medically incapacitated, but their loved ones can't make medical decisions for them and don't have access to their funds to help pay for their care. Every adult needs estate planning documents, which at a minimum includes a will or trust, a power of attorney, and a healthcare directive. Yes, this means as soon as you are out on your own, you should have these things. And it definitely means that as soon as you are married, if you get married, you need these things. And it absolutely, positively means that as soon as you have your first child, if you have children, you must have these documents. If you don't, then you're being a bad parent. That may sound harsh, but I'm being serious. If you have children and you don't have up-to-date estate documents, as well as designated beneficiaries, which we'll talk about in a minute, you are being a bad parent. Again, it's not about you, it's about them. Some people need a more complicated instrument called a trust, but the vast majority of people just need a will. You might need a trust if you have a special needs child or other complicated situation, in which case you should meet with an attorney. But most folks just need a will. A will is usually pretty straightforward. It's just a legal document that states who gets your stuff. That stuff includes your house, if you own one, your vehicle, if you own one, and all of the accumulated physical items that you didn't get rid of before you died. You can meet with an attorney if you'd like, but most wills are simple enough that you can simply do it yourself for free through a place like freewill.com. A power of attorney is necessary so that someone can make legal decisions, including accessing your bank accounts, if you are incapacitated. Without a power of attorney, your loved ones might have to pay for anything you need out of their own pockets, and might find it difficult to make routine decisions and payments for you. A healthcare directive is necessary to convey your wishes around your own healthcare decisions when you are not able to make those decisions. Without a healthcare directive, then your care is often left up to whatever the doctor and/or hospital decides is best from their perspective, which might not be what you want. What a will doesn't include, or at least shouldn't include, is your financial assets. All of your financial assets, which include, but are not limited to, your bank accounts, your investment accounts, both individual and employer-based, your pension plan, if you have one, and any life insurance policies should have a designated beneficiary or beneficiaries. All of these assets will pass to the designated beneficiary outside of the will, often referred to as outside of probate. This is both much easier and much quicker than having it go through the will. But this will only happen if you have designated beneficiaries on all of your financial accounts. Just like estate documents, you should name designated beneficiaries for all of your financial accounts as soon as you become an adult, and definitely if you get married and/or have kids. It's also important to make sure you keep those designated beneficiaries up to date. There are many cases where someone's ex-spouse inherits their financial assets because the deceased never updated their designated beneficiary. Or a cousin gets your assets, even though someone is now married and has 3 children, because they named their cousin as a beneficiary before they were married and had children. As soon as this episode is over, or maybe even now, you can always hit pause, you should log into all of your financial accounts and make sure the beneficiaries are up to date, reflecting your current situation and wishes regarding who you would like to receive which assets. And it's a good idea to set a calendar reminder for once a year to remind you to check your beneficiary designations. When that calendar reminder comes around, if there have been no changes, then you simply dismiss it and do nothing. But if there have been changes, it will remind you that you need to log in and make those beneficiary changes ASAP. In addition to doing this for yourself, and your partner if you have one, if your parents are still alive, you should also have this conversation with them. This can sometimes be even more difficult than making yourself complete these tasks, but you need to bite the bullet and do it. Mom and Dad, We Need to Talk is an excellent book that I highly recommend to help with those conversations. Note that this doesn't mean you have to ask them, "What am I getting?" Although for your planning purposes, it is really helpful to know that. It means that you want to make sure they have all of their estate documents and designated beneficiaries completed, for all the same reasons why it's important for you to have done so for yourself. If you are privileged enough that you do receive a significant inheritance, with significant being in the eye of the beholder, then you need to figure out what to do with it. Note that I'm focusing only on the financial aspects of this, not the emotional aspects. The emotional side of this can be very tough, but is beyond the scope of this episode. When you inherit assets, they come with a variety of tax statuses. Any assets the deceased had in taxable brokerage accounts come to you tax-free, because any unrealized capital gains get a step-up in basis. Unless you inherit a huge estate that is subject to an inheritance tax, any stuff you inherit from the deceased will also be tax-free, including their house, if applicable, because it also gets a step-up in basis. But the bulk of what most people inherit is often in tax-advantaged accounts, either traditional pre-tax accounts or Roth accounts. Roth accounts will be tax-free to you, but traditional pre-tax accounts will not. You will owe taxes at your ordinary income tax rates on any withdrawals from traditional accounts. Inherited tax-advantaged accounts also come with some specific rules about how quickly you must take withdrawals. These rules can be complicated, but the following applies to most people. Note that the following discusses inheriting from a parent, not a spouse. For inherited Roth accounts, you must withdraw the entire amount within 10 years, but there is no yearly requirement. For traditional pre-tax accounts, if the deceased was not yet taking required minimum distributions, RMDs, then you don't have yearly RMDs, but you still have to withdraw the entire balance within 10 years. If the deceased was already taking RMDs, then you also have yearly required RMDs during those 10 years, in addition to having to withdraw the entire amount within 10 years. And remember, these withdrawals, both the RMD each year and the final withdrawal at 10 years, are taxable at your ordinary income tax rate. Depending on the amounts of those withdrawals, this can push you into a higher marginal tax bracket. A good strategy can often be to take more than the RMD each of those 10 years, filling up your current marginal tax bracket each year in order to avoid, or at least lessen, a huge withdrawal in year 10. There are, of course, many ways you can deploy this money, but here are some suggestions. First, if you have any remaining high-interest debt, as discussed in episode 8, pay that off. Once you've done that, then you should consider using at least some of the inherited assets to boost your investing in what I call a side door IRA, 401k, 403b, 457b, HSA. As we discussed, inherited tax-advantaged accounts have to be withdrawn within 10 years, but that doesn't mean you can't effectively transfer them to your own accounts. You do this by using any taxable assets or RMDs from inherited tax-advantaged accounts to help fund your current living expenses, allowing you to contribute more of your paycheck to your own tax-advantaged accounts. For example, let's say you are over age 50 and are currently maxing out your Roth IRA by contributing $8,000 a year, and you are currently contributing $10,000 a year to your 401k through your employer. In 2025, that would mean you still have an additional $21,500 you could contribute to your 401k before hitting the limit. Before your inheritance, you might not have been able to do that because you needed that money to pay the bills. But if you now have at least $21,500 from inherited assets to deploy this year, you can max out your 401k and use the inherited assets to backfill for your lower paycheck. And if you're a public employee with access to both a 401k 403b bucket and a 457 bucket, you have much, much more room than that. If you're contributing to an HSA and haven't been maxing that out, you could also do that. If you max out all of your tax-advantaged accounts, then you can just add to your own taxable investments. And of course, You are allowed to actually spend some of the money on stuff or experiences instead of investing all of it. So we've talked about estate documents for yourself, as well as what to do when you inherit assets. But there's a third important area to consider. Perhaps you can leave at least part of your legacy while you're still alive. I want to be perfectly clear here. You should only consider this if your needs, and your partner's needs if you have one, are taken care of. You don't want to be in the position of helping your kids or other loved ones and then later needing their financial help. Put your own oxygen mask on first. But many of us are privileged enough that as we get older in retirement, we may realize that we will not be spending down all of our assets. That our assets are going to be more than enough to handle our spending and cash flow needs until we die, and that there will be a sizable amount left over. Again, sizable being in the eye of the beholder. Well, there's nothing wrong with that. Many people might want to consider distributing some of their assets before they die. There are two main reasons for this. First, while helping out your kids or other loved ones by leaving assets to them when you die is still a good thing, if you distribute at least some of your assets before you die, you get to enjoy seeing the results. Second, and relatedly, your legacy assets can often have a much larger impact on your loved ones' lives if they receive it earlier rather than later. Given the age we typically have children and current life expectancies, assets we leave at death are often getting left when our loved ones are in their 50s or 60s. Often by the time people inherit, their financial situation is reasonably stable, and those assets just end up being additional assets and not impactful ones. While that's still nice for them and helpful, it's often the case that if they had received some of those assets in their 20s, 30s, or 40s, it would have had a much larger impact on their lives. So, if you've put on your own oxygen mask first and find you are comfortable distributing some of those assets before you die, here are some popular ways to consider doing that. Family trips. Go on a big trip with your kids and their families, and pick up the bill. This not only counts as spending on yourself, but it's also spending down some of your legacy in a way that is enjoyable and makes memories for both yourself and your family. Help them with a down payment. If your children want to purchase a house, coming up with the down payment can be difficult. You can gift them the money, or even loan them the money with a low interest rate, to help them get into that first house. Contribute to a grandchild's 529 plan. As discussed in episode 14, you could also contribute to a 529 plan for a grandchild, either by gifting the money to their parents or contributing to a 529 plan with yourself as the owner. Be the employer match. As discussed in episode 13, getting your investing started early is really important in order to allow compound interest to do its thing. But those early working years are often also the years where it's hardest for young folks to find the extra money to invest. You can step in and be their employer match, encouraging them to contribute to their retirement accounts by giving them the extra that allows them to do that. In many cases, if you are able to do that when they are in their 20s, their retirement may be secured by the time they are 30, even if you aren't able to give them any more money after that. Let's take a quick look at a spreadsheet that illustrates this. Open this Google spreadsheet by typing the link or clicking on the link in the slides. It will ask you to make a copy so that you have an editable version. Click Make a Copy. This spreadsheet shows you the possibilities for the impact giving your children gifts while you're still alive that they then contribute to their retirement accounts can have. In cell B1, put the beginning age you start giving them gifts. In cell B2, put the number of years you will continue giving them a gift for this purpose. In cell B3, put the amount of the annual gift. In cell B4, put the assumed real rate of return. I've defaulted to the historical 6.8% real return of the stock market. In cell B5, put the assumed safe withdrawal rate you would like to estimate how much yearly income their accumulated balance could generate at different ages. Then rows 8 and below show the results. Note that the contribution amount in column B equals the amount you chose for B3, as well as the number of years you chose in B2. But if you want, you can manually type in the yearly amounts in column B if you want to change the amount for each year. Column C then shows the accumulated balance just from your gifting and the investment returns, not counting any additional saving investing they might do out of their own income. Note that the balance assumes you don't get any growth on that year's contribution, just the previous year's balance. Then, column D takes the safe withdrawal rate from B5 that you wanted to use as a comparison and shows you the amount of yearly withdrawals you could safely take from any given year's balance. If you scroll down, you can see the tremendous growth due to compound interest. For example, with the default numbers, I've entered $20,000 in annual contributions for 8 years, and then no contributions after that. They will end up with over $2.5 million in their accounts at their full retirement age of 67, cell C52. With my assumed safe withdrawal rate of 4%, that would generate over $100,000 in safe withdrawals each year. And that's $100,000 in today's dollars, so today's purchasing power. That's enough to retire on even if they don't contribute any additional money after what you gifted them for 8 years. You can play around with the numbers to see what you might be able to accomplish. There are, of course, many other ways you might give some of your legacy while you're alive. Some folks are concerned about the legality of gifting to your children, but for almost all of us, this is a non-issue. First, the annual gift tax exclusion is pretty generous. In 2025, each person can give up to $19,000 a year to as many people as they'd like, tax-free. So, for example, you could give your child $19,000 and their spouse $19,000 this year, and if you have a partner, they could do the same. So that's a total of $76,000 in a year. You can then turn around and give another $76,000 the next year, and probably more as the amount typically goes up each year, and continue that for as many years as you'd like. But even this generous limit isn't really a limit, as you are not actually limited by the $19,000 a year per person. You are limited by the lifetime gift tax exemption limit. In 2025, this is $13,990,000. The only requirement is that any year you give over the annual limit, currently $19,000, you file Form 709 with your taxes to document the amount. This allows the IRS to track your total giving to make sure you don't exceed the lifetime exclusion limit. For the vast majority of us, that's not a problem, so there effectively is no limit on what we can give to our kids each year. So, as long as your own financial needs are covered, you should consider gifting some of your legacy while you are still alive. In addition to giving the money now, you can perhaps make some other moves that may lower the taxes on the inheritance they might receive after you die. This could include withdrawing from your traditional accounts and paying the tax yourself now, so they don't have to pay taxes when they inherit the money. It can also include Roth conversions, converting some of your traditional tax-advantaged accounts to Roth accounts. This is a taxable event, so you would pay taxes now at your ordinary income tax rates. But then when your heirs inherit the Roth account, they won't owe any taxes. As discussed in previous episodes, it makes sense to consider your current marginal tax rate, as well as your heirs' anticipated marginal tax rate when they inherit, before doing this. One other thing to consider is charitable donations. You can, of course, give money to charities just like you always have. But there are some attractive tax advantages available to you by donating assets that have appreciated. For example, a qualified charitable distribution, QCD, allows you to donate up to $108,000, 2025 amount, it's indexed to inflation, from a traditional tax-advantaged account with no tax consequences. Even better, if you're old enough that you have required RMDs, then this donation can count toward or as your RMD for that year. And if you have unrealized capital gains in a taxable account, you can donate those shares directly to charity without any tax consequences, which means the charity gets the full value of your donated holdings, but you don't owe any taxes on the donation. Finally, if you have substantial assets, you might want to take advantage of a donor-advised fund, which makes administration easy and allows you control over your charitable giving. You can donate a significant sum all at once and claim a tax deduction for the donation in that year, and then distribute funds to charities over multiple years from the donor-advised fund. Hopefully, this episode has given you some ideas to think about relating to estate documents, as well as both receiving an inheritance and leaving one. This includes possibly front-loading the legacy you leave by giving some of it away while you're still alive. While it's crucial that you make sure you have enough to meet your needs, if you know that you're going to have extra, giving while you're still alive is attractive in many ways. If you're taking notes throughout this series, write a paragraph or two reflection on this exercise. Include a screenshot and a link to your copy of the spreadsheet. If you're comfortable sharing your reflection, there are several ways to do that. If you're watching or listening to this on Spotify or YouTube, then you can leave your thoughts and/or your feedback or questions in the comments. You can also always reach out to me directly on social media or via email. I'm Carl Fish on Blue Sky, Twitter, Facebook, and YouTube, or you can email me directly at carlfish@gmail.com. Our next episode will be the conclusion of this series, at least for now. We will discuss creating a financial inventory and revisit your personal financial philosophy statement from episode 1. We will also create your personal financial action plan and direct you toward resources where you can learn more about the topics discussed in this podcast series.